Okay, so today this video is very important for you. Today we will prepare an income statement in Excel step by step, just like you will do in CA or professional financial analysis. Okay, not only we will solve a practical problem, but I will also explain the logic behind every calculation. So quickly dive into it as I have a question there. The Alpha Traders Private Limited is a manufacturing company. The following information, yes, everything is given. So this is the trial balance. I will do very quickly without wasting your time. So let's start it. First, we have to details, adding the company name, etc. So I am just formatting it like this. Yeah, merger centered, and we can say the Alpha Traders Private Limited. Oops, Limited. And here as well we will merge and center it, and we'll write the income statement for the year ended 31st of December and 2025. Okay, now we have write it here and just move there and remove the guidelines. Here we will add I mean to say the particulars here, particulars, and here is the revenue, sorry, the amount, and just select both of these, go there and put, and just bottom borders, yes, particular and amount. Okay, so now we have this our trial balance, and just quickly we will uh, start our adding the values here, and I will explain also what does this means. So we begin with the sales revenue. Okay, first of all we have to add the revenue here, revenue. And now first of all we have the sales, sales, and this represents the total amount earned from the goods we have sold, and add there, which is here. Quickly we will do the sales revenue, which is 100,000, and just select this column and move to the accounting. Okay, mu1 customers. Okay, sales, and now we will we have a sales return there. What does this sales return means? These are the returns that, because these are the goods that customer have returned us, and return reduce our actual earnings, so we subtract them. So less the sales return. Okay, so we have sales return which are minus and 20,000. So we have less the sales return, so now we will have the net sales and add the net sales, which are actually the sum of these and this. Wait, yes, so 9,80,000 is our actually the sales return. And yeah, this is the whenever you see the word less, it usually indicates something that reduces income or value, such as returns, expenses, or closing stock as well. So this is our net sales. Now we will move on there and add some cost of goods sold. And yes, here first of all we have the opening inventory, and we will write the opening inventory, and our opening inventory is 100,000, sorry, 100,000, yes, it's 100,000. So this is our opening inventory. Then we have the purchases, and purchases are 500,000, yes. uh, because the opening inventories are the goods already available for sale at the beginning of the year, and purchases, these purchases are new items that we have bought, new stock during the year. However, if some goods will return to suppliers, we less them, the purchase return will be less because those don't form part of our cost. So we will less the purchases returns. Yes, we less the purchases returns, which would be our minus 10,000. So you see there the brackets, these are the accounting fundamentals. So that is why I select this column and turn this into the accounting format. So we have less the purchase. Next is we have the freight inward. What is this? This is because the transportation cost of bringing goods to our premises is part of the total cost of goods, because this is the transportation cost. You know that when you have to buy something and you give some bucks to the truck drivers and trucks petrol, etc. So these are the freight inwards, and just add them, add the freight inward. Okay, so adding the freight inward, we have this value is 15,000. Yes. Now we'll also less again the closing inventory. Now the question is why? Because these goods are unsold and still on hand at year end. They should not be charged as an expense this year. Instead, they will appear as assets in the balance sheet. My friend has a business, and his business is going very in a loss there, and his inventory is always have so much in the year in the closing inventory, so we add them into the balance sheet as an assets. So okay, so we will less the closing inventory, which is minus 1,20,000. So we have the, now we will calculate the total COGS, and yes, we will add the sum formula here, and here is the sum of all these, and yes, 4,85,000 is our total cost of goods sold. So now we will quickly move on for the next. After all addition and subtraction of these, think of this as way we add all costs directly linked to bringing goods to a saleable condition, okay, and subtract what remains unsold. Now what will be the next? It's the gross profit. Finding the gross profit. Gross profit is actually how much the uh, company made from its core trading activities before considering any operating expenses. These are the direct, these are the cost of the sales. So gross profit would be net sales minus the total cost of goods sold. So we will add the operating, sorry, gross profit here, and the gross profit is actually uh, the net sales. This is our net sales minus our total cost of goods sold. Okay, so 4,95,000 is our gross profit. This is much the company. If actually, if our gross profit percentage is also strong, let's add some the gross profit margin as well here. Profit margin. If your gross profit margin is strong, it means your pricing and cost control practices are also effective. So let's calculate the gross profit margin as well. And how to calculate it? Actually, this is gross profit divided by our net sales. So this is our gross profit margin. You make this into a percentage. This is 51% is our gross profit margin. We will analyze in the end. And now just add something like borders here, top and bottom, here as well, here as well. It looks very good now. Now what comes, it's the operating expenses. Okay, operating expenses. We will now calculate the operating expenses. Where is it is starting? It's starting from there. Salaries are the first. Salaries are our operating expense because we give it to the office works or any other particulars, and all of these are subtracted because they represent outflows of economic benefits. So salary expenses are 80,000 first, and then we have the rent, which is 40,000, and the utilities, these are the bills, and we have 25,000, and some of the marketing, advertisement. Without the marketing nothing works, so this is 15,000 is for our advertisement, as well as depreciation. You know what is depreciation is? The outdated, the every year our asset declining their values, so it depends on the percentage. So adding the depreciation is, which is the 20,000. So 20,000 the our depreciation, and now we will add the total operating expenses and just add our formula here, sum them, and here boom, we will have the operating expenses. 1,80,000 are our operating expenses. These are called actually the indirect expenses. They don't produce goods directly, but they help the business operate smoothly. So you understood it, that these are indirect expenses are also important. Actually, these are the expenses that are working and also moving our business. That is what. Now let's move to the next. Which is next? Yes, the operating profit. Now we'll find out the operating profit. Firstly, just make this as the bold, gross profit as well, make it italic, and yes, move on there. So we have the operating profit. How to find the operating profit is actually gross profit minus the operating expenses. 3,15,000 is actually our total operating profit, and this reflects the efficiency of the company's core, you can say, operation before considering any kind of operating income or finance cost. This figure is actually watched by the analysis. It shows whether the main business model is truly profitable regardless of external income. Okay, so now the next one is what we add. These are the main pillars, and also we have something which we have to add. These are the other incomes. We have calculated this. These are the other income. Interest is always the other income. We add this. So add the interest. Actually, this is the interest we are receiving. Okay, not the given. This is the interest, and we add it because it's an additional earning not related to main operations. For example, the interest earned on bank deposits are investment. I have the ABC person, which is which have deposited some amount in the bank, and he receives some interest on that kind of particular business. So this is the interest we are receiving. So how much it is? It's a 5,000. And just next is profit before tax and tax adjustment. So we calculate the profit before the tax. So profit before the tax is actually the operating profit plus our interest income. So this is our profit before the tax. What we will do now, we will less their values here, less the values of income tax expenses. Okay, we have income tax expenses which will give to the government, which is 30,000. Okay, you can add the minus 30,000. So these are our income tax expenses. Now we will have the net profit net profit, which would we have the uh, sum of the profit before tax and the less the income. So 2,90,000 is our actually the net profit, and after deducting of tax we get this, and this is the final profit available to shareholders, often referred to as the bottom line. And this is how much actually we have adding the operating profit margin we have missed there. So just insert, we should add the operating profit margin as well. So operating profit margin is actually operating profit divided by the net sales. So it's 0.3, I mean to say 32% is our operating profit margin, which is quite good. So you can say the gross profit margin, which is 51%. This means the company retains 50% of every rupee in sales after direct cost. Is quite good working there. Alpha traders. And operating profit margin, which is 32%, indicating the solid control over operating expenses. It's CMA is very working very good, And the net profit margin, let's find out the net profit margin, how much it is. Net profit margin, we have this net profit divided by we have the E10. So we have the net profit margin, which is 30% as well, nearly 30% of sales, which are converted into pure profit. A strong net profit margin usually indicates good pricing power, and you can say cost control and efficiency in operations. So hopefully you have understood this. I am also interpreting in the end that highest gross profit margin is cost of production is well managed, and stable operating margin is indicates good expense control. Okay, this control and this control, and this indicates our the health, overall financial performance of our business. So, and that's how you prepare and analyze an income statement in Excel. I can go through for some graphs as well, but looks very awesome. And if you found this tutorial valuable, please like it, share it, and subscribe it for more Excel based accounting. And comment below if you would like me to cover the balance sheet or cash flow statement analysis in the next. Thanks for watching and see you in the next session. Goodbye for now.